All right. I'm sorry about the delay there. I know your guys' time is valuable, so I think we should get rolling. This is Tom Randall again from GoldenCare. I want to welcome you to this webinar. I tell you, it's our pleasure here at GoldenCare to bring you great products that can do some great things for you and help as many people as possible. And this NGL product is really just another piece of that puzzle. So we're really excited today, and it's my pleasure in a couple seconds to introduce Marc Glickman. Marc is from LifeCare, and they help administer and help design this product, and I'll let you do that intro, Marc, in a second. But basically, with this plan, you guys, this is a nice plan. There's not a lot of newcomers in the long-term care industry, and I'll tell you what, this one has the ability to get lifetime benefits Marc will tell you about. It's got single and 10 pay. It has a great, unique reverse combo concept that you'll see, and he's got some great tools with the BenefitsBuddy tool, et cetera, that Marc will show you in a second. So that being said, it is my pleasure again to turn this over to Marc, and at the end we'll open it up for questions. We are in presentation mode. Be on the lookout for emails from GoldenCare afterwards to try to get you pushed forward to take the next step, which is important for you agents to go ahead and get appointed. When you see a great product like this, just add it to your portfolio and make sure we can help you have some more success out in the field. So that being said, Marc, if you're ready to roll, I'll turn it over to you. I think you have control of the screen as well.
Yeah, and thank you for hosting. Thanks to GoldenCare for setting all this up. Really excited to be offering you this new product. We spent many years designing it. We think what you'll see you'll really love. So I'm going to jump right into it. Tom had mentioned we actually just developed a new tool for illustrating, for doing plan design, for showing to your business partners the value of long-term care. And so this is called BenefitsBuddy. We're going to spend a lot of time towards the latter half of this presentation going through the charts here, explaining what you see here, but I think you'll find it pretty exciting, the new product features. Just a brief introduction. This is actually the first webinar in a three-part series that we have. I am actually going to be touching upon all three components here. The main part of the presentation will be talking about traditional long-term care opportunities. As Tom mentioned, single pay, 10 pay, lifetime benefits. We have these features that are much needed on the market again. Again, a lot of people have different long-term care planning needs. There is now a family of long-term care products, whether it's traditional or combo products, to meet those needs, and this really fills in a missing gap in the marketplace. I'm also going to be talking about some of the unique opportunities with traditional long-term care that we can bring back to the market because of the features that we have. So the first one is executive carve-outs. So we're going to spend a little bit of time on how this works for business owners. The fact that you can take tax deductibility like you can for health insurance is a really big advantage, a really big incentive to get people to buy it while they're young and healthy and they can still qualify. So this is really exciting. Again, the 10 pay kind of lets you do that, and of course the lifetime benefits helps as well. We're also going to be talking about some newer opportunities. 1035 exchanges really hasn't been on the market for all that long. The Pension Protection Act allows you to take non-qualified life insurance or non-qualified annuity cash values that your clients already own and use those cash values to pay for traditional long-term care insurance. The great thing about this is we have a single pay product as well. So not only do you get a guaranteed premium, but you can do that exchange in one transaction. So we're going to talk about the value of 1035 exchanges, which have become a really hot market today. And then finally, we're going to talk about the combo market a little bit. We have a new combo product, as Tom mentioned. We call it the reverse combo. It's return of premium and a cash surrender option that's built on the traditional plan. There's a lot of flexibility with that design, and we'll talk about some opportunities there as well. So a lot of topics, a lot of potential markets. We're going to cover them all today. I know, just jot down some notes on the ones that you think are most interest to you. Come up with some clients that you think might take advantage of these. Bring them back to Tom and his team at GoldenCare. He'll loop me in if you need it, and we'll help you get set up and figure out what the right plan is for your client. So just a little bit of background introduction on me. My name is Marc Glickman. I'm Vice President of Business Development for LifeCare, and I'm actually an actuary. So I have a unique perspective on the product in that I helped design it. I also developed this BenefitsBuddy tool. So I've been working in the sales space, and I've been listening to agents and specialists and BGAs tell me, okay, here's what we're looking for in terms of long-term care. And we've really tried to design this product perfectly for those needs. If you do have any questions and want to get my feedback, my information is at the bottom of the screen here, or you can contact Tom and he can help direct you to me as well. So why did we create BenefitsBuddy? A few different reasons for that. You know, in today's world, there's a lot more technology capabilities, and we wanted to create a visual way to really simplify what a lot of people perceive as a complicated product. So we're really focusing on the big picture features, and because we have all of these new opportunities with the EssentialLTC product, it really allows you to design a plan customized to your client's needs. It will actually, when you look at the tool, you'll actually find new markets that you may not have really thought about existing before. There's opportunities with 5% COLA today, which a lot of people would think was too expensive. You can actually use it in very effective ways. There's opportunities with the middle market. I'm going to show you some very basic, inexpensive plan designs. And as long as you know your client's target premium, what they're looking to spend on the plan, and you do your pre-underwriting, you're going to have a very good experience offering them different features across this spectrum of product design. And then finally, I hope it changes the way you view long-term care, or at least for your business partners, because if they say it's too complicated or it's too expensive, or I'm worried about rate increases or use it or lose it, we have features on this product to address all of those needs and objections. So you should be able to show those to your business partners and hopefully get a lot of people excited about long-term care once again. So just a very basic introductory background on National Guardian Life, who is the carrier for this product. They are new to the long-term care space, which we actually consider to be a good thing because they don't have any legacy long-term care issues or liabilities. And so they can really take all of that we've learned in the long-term care industry for the past 30 or 40 years and use it to their advantage to price the product today, obviously in a much more stable way, design it with exactly the right features, and take away those things that led to risk issues for the other carriers in the market. So you're not going to hear a lot of negativity about National Guardian Life because, again, they're starting off with a clean slate here. They are a stable mutual company that's been around over 100 years. They're A- rated by AM Best. They've been A- rated for over 20 consecutive years. And they're actually licensed in all states, it says here, except for New York. There's actually a recent update to that. They did demutualize a subsidiary that's based in New York, and we do expect this to have it in all states very soon. So this year we're expecting it in all states except for New York, or maybe by early next year, and we're actually planning at this point to file in New York as well. It takes a little while to get it approved in New York, so stay tuned for that. Now, LifeCare is the company that I work for, and NGL has partnered with LifeCare as an expert in the long-term care space. So LifeCare has been around over 30 years, or actually, sorry, almost 30 years in long-term care, and we've launched a number of products for some major carriers that you might be familiar with. In the 90s, we actually designed Allianz's product, Lincoln Benefit Life's product. We did State Life's traditional product, Berkshire Life, which is a Guardian subsidiary, as well as Mass Mutual. So if you've sold any of those products over the past few years, you might see a lot of commonalities with this product design as well because it was designed by the same folks. So we're using that same mentality, and we think it's going to be a very successful product that's much needed out there in the market. So just kind of address some of the concerns about long-term care and how to offer this to your clients. It's really important in today's market that you are proactive with your business partners in terms of today, obviously, traditional long-term care, generally speaking, is trying to identify people that are proactive with their health. You know, they're seeing the doctor regularly. They have reasonable build. You know, tends to be non-smokers. Tends to be people that are thinking about longevity risk. Okay, people are going to live a long time, are going to get a lot of value from long-term care because the majority of the claims paid are for concerns due to aging, so chronic illness due to aging. So that typically is the ideal profile. In today's world, you do have to approach them earlier than you used to. So, you know, 50 to 65 is really the target sweet spot for long-term care today. Obviously, it is available for people 40 to 79, but I think you're going to find the most traction right in the middle of that range. And then the key thing about this is you really want to understand what risks are the client or the client's advisor looking to protect against. Okay, are they looking to maximize their long-term care leverage? Are they concerned about rate increases? Are they looking for a product that doesn't have use it or lose it? If you know the answer to that question, you will be able to find a product feature on EssentialLTC that will work perfectly for that client. So we're going to go through a lot of those options here, but it's very important to understand what the client's trying to protect, what their hot buttons are, what the advisor's hot buttons are as well, the trusted person who's the gatekeeper there. And then, you want to know their target premium, which is really critical. If you start off with the target premium, you will have a lot of fun doing a customized design. So we're going to look at some target premiums and what you can design for your clients here as well. And then finally, you'll always want to ask the question, is your client a business owner, or does your client have existing non-qualified life or annuity funds? And we'll talk about why. But if you know that information, you can put together the perfect long-term care planning solution for them. Now, really briefly, I want to talk about underwriting on this in the next slide as well. And one thing to note is that we are very active in promoting that traditional long-term care is for people that are proactive with their health. It's just the way that we can offer a plan with this many different features. There are many other products in I call it the long-term care family of products. So we don't see them as competitive. We actually see them as other alternative solutions. So if you have a client that wouldn't qualify for traditional long-term care, there are a lot of great combo products out there. There's a lot of great products with chronic illness riders. If they're less healthy, short-term care products. If they're already on claim, there are great SPIA products out there for people that actually already are eligible for claim. So wherever they are in their health, you can find a solution for them, and this is just that solution for those people that are proactively addressing their long-term care needs. Now, because of that approach to the market, NGL tends to issue a lot more in our best rate class. Okay, so don't be shy about quoting it. I do encourage people to quote conservatively because I think it's a good strategy to set expectations relatively low and knowing that we'll automatically upgrade them if they qualify. And after they qualify for the better rate class, you can then get them lower premiums or increase their benefits at your option there too. So we tend to issue about 30% more people in our Preferred Plus rating class. We also issue a lot in our middle rating class. And those are the two that you're going to quote the most often. So just a very basic overview of what that underwriting looks like. I like to ask 3 questions. The first one is about build, and it tends to be a liberal chart, so it's not, most people will qualify, again, if they're at least a little bit proactive with their health, they're seeing the doctor regularly. The example here is a 5'9" male, has to be under 210 pounds. Okay, so there is a wide net for this. The second factor to look at is, are they a smoker or non-smoker? And the third factor is whether they have any serious health conditions that are really associated with a long-term care risk. So if they can answer those questions satisfactorily and they have no issues, then they are Preferred Plus in our world. It's as simple as that. If they have one of those issues, they tend to be preferred. And generally speaking, if they have multiple issues, that tends to be what pushes them out of being able to buy traditional long-term care. So very important to go to the client, help them understand their longevity risk if they're healthy, if they're seeing the doctors, and then offering them traditional long-term care in advance of the need. One of the good criteria to use as well is if they've recently been approved for the preferred or best rating class for life insurance or disability insurance. Those are great indicators that they would qualify for long-term care, and obviously they're kind of in the market. Again, just getting their budget will help guide them into the right plan solution for them. This is a great referral product. So once you design some of these plans for trusted advisors, oftentimes you will become the long-term care expert referral source for that provider in their network. Financial advisors, CPAs, attorneys, a lot of high net worth people who have clients that are perfectly suitable for long-term care will have somebody to go to for their long-term care needs. So with that, I'm going to jump into the product features in much more detail. We're going to separate it into 2 core markets. So the first one being your traditional long-term care markets. We're going to look at a little bit of the competitive pricing. We've designed a plan that has extremely attractive leverage for the premium dollar. This is why we call leveraging it a slice to protect the whole pie. Again, if they qualify for long-term care, they're going to get a lot of potential protection. And again, the reason we can do that is because of our underwriting approach. Secondly, we have a joint policy design, and it's very unique on the market. It might take a little bit of getting used to, but you'll find it to be beneficial. And we have individual male and female prices on those products, so those are pretty common across the industry. But if you have a couple and they're both healthy, and the 2 people just need to be living together, most often they are spouses, if they apply for coverage and qualify, then they are eligible for our joint policy. And the way the joint policy works is that each person gets their own benefit pool, but they only pay one premium. And that premium is actually going to be priced at the older age of the two, and the joint rate happens to be exactly the same as the female rate. So what ends up happening is if you have two people and they happen to be the same age, for example, you would be buying the female and getting the male for free. So instead of having a spouse discount, we have this very unique joint policy design. The other unique feature to pair with this is we have a shared benefit rider, but it offers a third pool of benefits. So if either person or both use up their initial pool of benefits, they can tap into this third pool. Because of that, they effectively can add on 50% plus more benefits to the end of their benefit period if they run out of a limited benefit period policy. So it really makes an attractive solution that begins to approach those lifetime benefits. We also have the option, though, to buy lifetime benefits. So you don't have to worry about running out of benefits anymore. If you have clients who are affluent, they want to put that risk away forever, there is an option for them here as well. And then we also have the ability to short pay the policy. So if you don't want to pay lifetime pay, if there's a concern about rate increases, the 10 pay mitigates the risk. So after the 10th premium, they're guaranteed not to have a rate increase. Within the first 10 years, it's highly unlikely a rate increase will happen. And even on the lifetime pay, we think with today's more stable pricing and the underwriting approach, we think it's less likely to have a rate increase than it was for past products. The single pay option is a guaranteed premium. So you pay one-time premium, and you don't have to worry about the risk of rate increases. That's a really hot-button issue today, and we can take that fear off the table. Now, we're also going to talk about the advanced markets. Keep in mind that some of these might be new spins on some old concepts that you're familiar with. For executive carve-outs, for example, we'll be looking at some different business owner situations, C-Corps, but we can do this for any business owner. It could be a sole proprietor business. It could be a financial advisor or insurance agent that owns their own business and still wants to buy their long-term care by buying it as a health insurance deduction through their business. So we're going to talk about some different situations that you may not have seen before. The 1035 exchanges, as I mentioned, is a new opportunity, taking existing life insurance or annuity coverage and applying it towards the long-term care premium. And then finally, we have a combo product. So if your client says, I don't want to buy traditional long-term care because I don't want to get, use it or lose it. If I don't use the benefits, I don't get anything in return. We have the ability to take away that objection. So very briefly, I'm going to speak of the three advanced markets opportunity, and then I'm going to jump over to the tool and I'll show you how these work. Okay? So for a C Corp, it is tax-deductible premiums for the corporation. And I will make an important note here, caveat, which is you always, always, always have to get the tax advisor for the client to opine on the deductibility because every business is different. Now, these are the general rules for how it works, so you will lead the tax advisor down the path to understanding how the deductibility works. 99% probably haven't even heard of this concept. Once they get their arms around it, they'll become experts for their client, and they'll be able to refer to other clients. So keep that in mind as I'm going through this. Now, executive carve-outs for C Corps, fully deductible for the corporation, not imputed income for the executive. So you're taking a deduction, you're not having to pay it back for that individual person who the deduction was taken for, and the benefits are received tax-free. So it's this trifecta opportunity that's really not available in very many, if any, other insurance products. If you do an executive carve-out on disability income, for example, it actually works a little bit differently without having the tax-free benefits at the end. You pay back some deduction in some way, shape, or form. With this one, deductible and the benefits are received tax-free. So it's a great opportunity for anybody who owns a business, and for a C Corp, it's not imputed income. If you're doing this for all other business types, it is actually pass-through income to the individual. However, and it's different from the individual tax deduction for long-term care, you can actually take this as a self-employed healthcare deduction on the first dollar of premium, but it's limited to these age-eligible premium limits for long-term care. Okay? So let me say that again. For the individual deduction for long-term care, it's an itemized deduction, and therefore you have to have at least 10% of your adjusted gross income as a medical expense before it kicks in. For a business owner, even a small business owner, it's actually a partial or full self-employed deduction, which is line 29 of the 1040. So it's treated just like a small business buying health insurance, and you can actually take it as a deduction on the first dollar. So that's why we can do this for any business type. We can also do it just for the owners of the business because it's not subject to discrimination testing, and it can also be done on a 10-pay basis because we have that option, meaning that you could have a business owner who's 55. By the time they're 65 and retired, they're paid up in their long-term care. They were able to take it as a tax deduction as long as they were earning income in those last 10 years of their working years, and they're covering their long-term care needs, potentially in full with the benefit features we have. So really a great opportunity. It's because we have this really unique Essential LTC plan. It also is allowed to cover spouses under the health care deduction, just like health insurance, and we have a 5% discount available for employer groups. Now keep in mind, this isn't your typical employer group situation because we are individually underwriting everybody who qualifies. Tends to be smaller business owner and executive groups, 1 to 10 people in size. As long as the business has at least 5 employees, they're eligible for the discount, but only one person actually has to apply for coverage in all states except for Ohio, where it's 2, meaning that you can get the discount even with a very small group because we're underwriting everyone. So that's an overview of the executive carve-out. We're going to come back to this with a few case studies towards the end using the BenefitsBuddy tool. The second big advanced market opportunity is 1035 exchanges. If you have a life insurance or annuity policy and you're doing an exchange where the ownership and the insured are the same on the existing, let's say, annuity policy as the new traditional long-term care policy, the Essential LTC plan, then you can actually do a tax-free exchange. This is allowed by the Pension Protection Act, and we're going to get into more of why this is such a big opportunity today, but it might be familiar to you if you do this with life insurance combo products today from other life insurance products. The big difference with traditional long-term care is that you can actually take annuity funds and use them to buy the long-term care coverage. That's totally unique because we have the single pay plan. It's going to open up a big new market in taking annuity funds and using them to fund the longevity risk and long-term care planning instead. And then finally, combo products. We have a combo product on this particular Essential LTC plan. It's complementary to the other products on the market. And the reason I say that is because it's going to actually provide more long-term care leverage and less life insurance benefit, okay, because you're getting return of premium on your traditional long-term care plan. We'll take a look at what this looks like, but I think there's 2 ways to think of how to offer these products to your clients. One is as a health-based product funnel, meaning once you pre-underwrite your clients and you know whether each individual will qualify, including if they're in a couple, whether they'll qualify, you'll be able to figure out which particular planning solution is right for them. You might offer traditional long-term care to one of them and offer short-term care to the other based on health. You might offer them the joint plan because they're both healthy with traditional long-term care. But you'll be able to use the family of products to address any of the health issues. The second way to look at this is also as what is the client's primary motivation for buying the policy? Are they looking for long-term care protection? They're going to get the least expensive solution in the traditional long-term care market. If they're looking for life coverage, they're going to get a really great solution with a life combo product too. So you want to figure out what is their primary motivation there. So with that, I'm going to jump right into the BenefitsBuddy tool. I know I've teased you long enough, and I want to show you how this works. You can actually download this from the NGL website. I'll show you at the end how to get access to this. You can also contact Tom and his team at GoldenCare. They can send you a copy of this. This is how you'll want to explore the product, at least in my opinion. I'm an actuary, but I think you'll enjoy the visuals that you see here. So the way that the premium calculator works is you actually type in the features that you want to select for the plan design. And you're also going to do something where you're going to assume a certain age at which the client goes on claim. I'm going to start off with an age 60 male who's going to go on claim at age 80, so after 20 years. And he's going to use his benefits in full after his 90-day deductible elimination period. And what you'll see in the visual here on the bottom right side is the annual premium, in this case, for this individual male. It's $250 per year. You're going to see the total premiums over 20 years, which in this case is $5,000. And then we're going to look at the total benefits that are available under the policy. Now, the policy I designed was very inexpensive, a very slim policy design that offers $50 a day, a 2-year benefit period with no COLA. So the total benefit pool available at age 80 is 50 times 2 times 365, which is $36,500. If he uses his benefits in full, and of course with a skinnier benefit period and a skinnier daily benefit amount, he's more likely to use more of the benefits. If he uses them in full, once you take into account the premium he paid in, he's getting about 7 times return, if you will, on his premium. Now that's if he qualifies for the 2 of 6 ADL triggers or severe cognitive impairment, so the same types of triggers as you're familiar with. But the key thing is he has a lot more protection available than he paid into it. And this is my value metric, the 7.2. That's the number we're going to keep an eye on as we go through a lot of the more affluent solutions. But if you know the client's budget, you might have a client that says, I only want to spend $500 or $1,000 per year. Rather than not offering them any type of coverage, you can offer them actually a pretty good plan design. I'm going to speak to the benefits of this really basic plan design. $50 a day, you know it won't go that far in terms of covering, facility care in the future, but it might provide 1 to 2 hours of home health care. It might provide a relief for his primary caregiver, who might be his spouse or child, right? It's going to give him the care coordination, so at that point in claim, which is very stressful, he'll be able to develop a plan of care. This is a planning solution for somebody rather than not buying anything at all, okay? So I can't stress this enough. Long-term care isn't expensive as long as you meet the expectation of what your client's looking to pay for long-term care, what they can afford. And this is a middle market solution that's available today. Of course, the benefits are still tax-qualified benefits, so they'll receive tax-free generally. And also, if that client were funding it out of their own pocket, they might have to pay, let's say, capital gains tax if they liquidate investments, right? There might be really struggles trying to come up with that cash at that point of claim. So it does buy them time. Okay, so that's the key thing to remember. We're going to really spend more time on the affluent solutions today, the really unique NGL features. But I want you to know is that as long as you pre-qualify them, so each individual, and if it's a joint, both of them, you will be able to figure out what is their budget, how to design a plan using this tool. So the very first thing we're going to look at adding to this is COLA. It's the most popular rider in the entire market today, and we're going to add it onto this basic plan design just to show you kind of the cost of that. You'll see that the benefit went up almost exactly double, and the premium went up almost exactly double, okay? So the ratio actually didn't change at all. That wasn't a glitch. It just happened to be the break-even point for adding COLA. Now, most people that are healthy go on claim more than 20 years from when they buy the policy. So we tend to see COLA added as the most popular feature because it will provide more benefits if they go on claim later. And just to demonstrate this, I'm going to go back to no COLA for a second. I'm going to change this assumed age of claim at age 85, which is more of the average today in terms of when people go on claim. Females later than males. There's 5 more years of premiums paid in, so that was added here. And you'll notice the benefits didn't change because there wasn't COLA on the policy, so roughly about 6 times. Still a valuable policy design, but a little bit less in terms of the value metric. If you add back on the 3% COLA, what you'll see is that value metric, again, increases because your benefits are still accruing to age 85. And now instead of $50 a day, you'll have $105 at age 85. So again, more coverage with that COLA rider. Very common. You can use this tool to figure out when it makes most sense for your client. The next thing I want to share with you is the joint policy design. So I'm going to change this to joint here. And you'll see there's a drop down there. And the one thing you'll notice is that the benefits are now for each person. But the premiums didn't double. Okay, they were less than double. So you're actually going to get more value out of this plan if each person uses their benefits in full. And that's really where this joint policy becomes quite attractive, is now you're getting benefits for each individual in this couple. Of course, the cost of taking care of 2 people is less than taking care of 1 person because they have a built-in caregiver, and there's a lot of actual data, and that's why you get a spouse discount on other policies as well. And that's reflected in why this joint rate looks so attractive. One other thing you can do on this plan, and this one is actually quite unique, is the shared benefit rider. If you add on the shared benefit, you're going to add on a third pool of benefits that's the same as their limited benefit period here. So in this case, it will be an extra 2-year pool. And you can see how that's reflected here. And again, you're going to add value to this because the cost of the rider, the shared benefit rider, is typically very affordable. They have to use their initial benefit period coverage first before they can tap into it. Now, you might notice that the shared benefit plan is actually a little bit bigger in terms of the amount of total benefits available than the initial plans. That's not a typo there, actually because by definition they're going to use it 2 years later, and they have 2 more years of inflation in this case building on it, the policy. Okay? So we're going to use this concept, and we're going to continue to build what's more a larger plan that you might see today. Right now we're under $1,000 a year plan for 2. So like I said, affordable joint coverage for 2 people. We're going to go into more a higher daily benefit now. Let's look more closer to the cost of care today. It tends to be about $150 to $200 a day that most people buy. In some areas, it's even higher than that. So we do $150. You'll notice that the ratio doesn't change at all. The benefits simply go up by 3 times because we bought 3 times the daily benefit. The premiums went up by exactly 3 times. So it's all a constant factor here. Now we have about $700,000 of coverage, and now we're looking at an asset protection solution. Okay? In most states, when you have 3% COLA, you're eligible for the partnership plan. It will vary based on states, and we expect this to become partnership qualified by the end of the year as well. Not yet partnership qualified, but you can see that a middle market solution might help against Medicaid planning, asset disregard. Now, when you start adding more benefits, it starts to get into this mass affluent space, more towards where your clients probably are in terms of long-term care today. This is a $2,700 plan for 2 people. Again, still not got the 2-year benefit period with the shared benefit, but you'll see a lot of value on the underlying coverage. You'll start to look at adding to the benefit period, and I'll say this is where NGL starts to really pull away from all the other carriers in the market, especially with the shared benefit rider, but even without. As you add on more of the benefit period, you'll see more and more value from the NGL plan. So a 3-year benefit period, you have about $1 million of protection, and now you have 14 times in terms of this value metric. If you do a 4-year plan, which is 3 4-year pools in this case, up to $1.5 million of protection for 2, and 17 times on the value metric. If you add on the 5-year plan, total of 15 years of benefits, $2 million for 2. Now you're getting over 20 times on the value metric. So like I said, as you have more affluent clients with more assets to protect, this is starting to approach a lifetime benefit period. Again, it's not lifetime benefits, but you got 15 years for 2 people, and it's probably much more than you might even be offering today. It's $3,600 covering 2 people, so it's right in that price range, what people are looking to pay if they have assets to protect. So I think this is a comfortable price range. So this is where we start to go off of EssentialLTC as similar from other plans, even though we have some unique features like the joint and the shared benefit. And we start going into some features that are not offered anywhere else. Okay, so the first one you'll want to look at is lifetime benefits. The lifetime benefit plan, which thing you'll notice is it'll give you a message on the shared benefit. Of course, you wouldn't buy the shared benefit because you already have an endless benefit pool for each person. So it will calculate it, but you'll take this rider off. And one thing you'll notice is we actually calculated a benefit pool. And the way we did that is we took your assumption here. So starting at age 85, they're going on claims for both people. And we're assuming that their claims end at age 100 in terms of lifetime benefits. So you have 15 years of claims for each one. But you can control that. If you want to see the value of 2 10-year claims, you can change this, and now we have 2 10-year pools that are calculated. 2 5-year claims, for example, you can see the value of the underlying coverage still. There's still a lot of value on the premiums paid. So the key thing to remember is that the lifetime is a valuable solution for people that are concerned about longevity risk. They have a lot of assets to protect. If they only have 2 5-year claims to protect this much, but if they have much longer claims, you have kind of that endless benefit period. Take away that fear on lifetime benefits. Okay, so that's where lifetime benefits plays into a role. Now, I'll say a lot of people buy the 2 and 3-year plans. A lot of people buy the lifetime plans. The 5-year plan is right in the middle, so I'm going to show you kind of where the average plan is today. I'm going to use the 5-year shared care for the rest of the examples that we show here, okay? Now, we're going to jump into the short pay option. The other big features that are so exciting is that we have the ability to take away a lot of the concern about rate increases. So for lifetime pay, $3,600 over 25 years would be $91,000. If you do a 10 pay, you'll see that there is a lot of value on the 10 pay. Now it's an $8,700 plan for 10 years, which is only $87,000, so less in terms of total premiums, but you're paying them sooner, so keep that in mind. But again, not a lot of extra margin load built into the 10 pay plan to get access to taking away some of that fear of rate increases. Your actual value metric goes up because you're paying less total premiums. This is not a discounted number. Still getting that same protection on the 5-year shared care for this individual. Now, this is really a good point to look at single pay as well, because guess what? Same thing happens. Now we have $84,000. It's a one-time premium. It's a fully guaranteed premium. So if you have advisors that say, I want a guarantee, this is actually a guarantee. Again, significant long-term care benefit. Now, I will note that this is actually one of the most popular features to offer when an advisor is looking at combo products. Now, even though it's not offering a cash value if they don't use the long-term care, a lot of people are buying combo products because of the guaranteed premium. I would say about half of them. And if you want somebody just to take away the guaranteed premium, but cost their client, $50,000, $100,000 less because they're not buying the life insurance, this is actually what I see quoted quite a bit. So you want to take a look at single pay if you're looking at combo options in particular, if that's the client and the advisor's hot button issue. If they are concerned about use it or lose it, we have the ability to add what we call a reverse combo, but it's really return of premium. And the way it works is if you add on the limited return of premium, you'll notice the benefit pool didn't change, but if the client doesn't use their long-term care benefits, they get their money back as a last-to-die return of premium death benefit. Okay? So at age 85, in this case, we just assume that that's when they passed away without using their long-term care, $140,000. If they use their long-term care for either or both of them, this death benefit is reduced dollar for dollar. So as long as they hold on to their policy, they're never going to get anything less than their premiums back eventually on the policy. So no real fear here of buying a policy and not getting something back. So again, taking away the use it or lose it objection. We also have what we call more of a full reverse combo, where you can add on a rider for 10% extra and you get a cash surrender option. So after the 4th year, if they don't use their long-term care and they want to get their money out of the policy, the $154,000 they put into the policy, they can get 80% back, so $123,000 right here. So live, die, or quit. This is not your uncle's long-term care policy, right? This is not use it or lose it long-term care. So whenever I hear that, I think, okay, there is a solution. And the great thing about this solution is because it's built on a traditional plan, there's no limits to how you design it, like there is on the life insurance regulations. So you can add lifetime benefits to this plan. So we can do that here, and you can use this tool to see what it would look like. You can add, let's say, this as a 10-pay or a lifetime pay. So you can do this instead of being a single pay, you can do it as an annual lifetime pay. By the way, this still takes away some of the fear of a rate increase because, again, you're going to eventually get either your long-term care benefits or your premium back to you. So if you pay a rate increase, it's coming back at some point. So, again, a lot of flexibility in how you design the plan with this reverse combo option. So take a look at that. Now, the next thing I wanted to share with you is I wanted to jump into some of the advanced market opportunities. I'll spend about 10 minutes on this, and if you do have any questions, just feel free to type them in, or I think we'll open up the lines and take a few questions with the last few minutes here. So the very first thing I want to share with you is the executive carve-out. And when you see 10-pay, if you sold this 15 years ago, that might be where your mind drifts, is executive carve-out plans. Now, this particular tool, which is called BenefitsBuddy, you can download. The tools that I'm about to show you are prototypes, and they're tools that we probably will release towards the end of the year. So this is just a sneak peek at some new things that we're building with this BenefitsBuddy concept. So this feature is called BusinessBuddy in this prototype. And what we'll do is the pie charts will change such that the benefits are over here, and the premium, we're going to actually drill into the premium, and we'll figure out what does the tax deductibility look like for this potential client. And again, it's hypothetical. You do have to get the client's tax advisor always on these cases, so you can't just quote this to a client. You need to kind of work with their tax advisor, but this will allow you to design the plan so they can see the value of this long-term care planning solution. Now remember, you're taking this deduction as a 10-pay deductibility. So if they're earning income through their C Corp, the way it works is you would take the premium as a deduction, just like health insurance, and because you're getting tax-qualified benefits, the tax savings in the future will be whatever their tax rate is times that deductibility for a C Corp. As I mentioned before, for a small business, it becomes pass-through income, and it's a self-employed deduction, which has a slightly different implication, meaning that it's limited to the age-eligible premium limits. In 2017, these were the limits based on age. So if we look at an age 60 couple, what you'll see for this particular plan design, which was very robust, 3 5-year pools, remember, each person gets to take a $1,500 deduction because they're age 60 in the first year, 2017. In 2018, they'll be able to take $4,100, plus the IRS tends to index these limits about 3 to 5% per year, as they've done for the past 20 years. So I've assumed that the IRS is going to continue to do that. Again, that's an assumption, but it's highly likely that in the 4th year, this premium for a small business owner, could be just a sole proprietor, is fully deductible just like a C Corp. So we pretend that they have a 35% tax rate, they get about 32.5% in tax savings. So there's a lot you need to know about the concept, but I just wanted to illustrate the value, particularly for any business out there. Now here's the great thing about the tools, is that you can design these plans really easily as long as you understand that this is the basic concept. So if you have a C Corp in this situation, we take their $87,000 of premiums and we think about what are the future tax savings going to be and add them up. Their net costs after taking into account the tax savings is only $56,000. We took an underlying plan that had tremendous value and we added additional value by being able to take it as a tax deduction. So almost over 30 times in terms of their total benefits if they use them in full on asset protection. And a much more affordable premium, and obviously a solution that a client's going to love if they're thinking about, okay, I'm earning this income, this is a great way to get my long-term care coverage. It really gives them incentive to do that. Now we're going to look at the chart with the small business situation that I just showed you. And one thing you'll notice is that not all of the premiums are deductible because we're using the age-based limits, but only about 6,000 are not deductible out of the 87,000, meaning that your tax savings are virtually the same. You can do a lot of things with this plan. The first thing to note is what is your client still, what is their target premium? What are they looking to pay? You're not just looking at the tax deductibility. You're going to design a plan that's right for their long-term care needs. But let's say you want a $7,000 premium. You can use the daily benefit, for example, to use this as a target premium calculator, and so you get to something that's close to $7,000. So you'll notice it's $120 a day, get a $7,000 premium. You actually can take advantage of a little bit more of the tax savings because the premiums are lower and you get to use more of the age-eligible limits. Here, the second year, it's fully deductible. So I would say the deductibility is secondary to the primary need and the primary budget that the client's trying to meet. You can also do this with lifetime pay. Just keep in mind that you have to be earning income. So in this case, we're projecting them out to age 69. Are they going to be earning income at that point in the future? Those are considerations you want to use. You're also going to be looking at different ages in some cases. I put here the secondary age, so the primary is 60. If their spouse is instead of 60, let's say they're 55, you'll notice that these limits change. You're still going to get a large portion of the deductibility, 31% tax savings here. So obviously a lot of different ages work. Even individual policies, they work great. You're going to get some tax savings, which is always better than not having anything at all. Even if it's only 5 or 10%, it's that extra incentive that's needed to really get the client to be looking at long-term care. By the way, here's how the chart looks with a person age 55 here. Okay, so I'm going to jump. This is actually the business owner concept. If you do have clients in mind, just again, bring them to Tom and his team. We'll actually do a screen share webinar, and I'll let you kind of use the prototype tools before you have access to them to help you understand how to do this for some real client situations. The other big opportunity I want to cover is the 1035 exchanges. And we're going to use a very similar tool, but I want to start off by showing you the benefit structure. Now, we tend to see this opportunity currently on individual policies more than we see them on joint policies. And the reason for that is that it has to have the same ownership and same insured on the existing annuity or life insurance contract when you're moving over the cash value as the new long-term care contract. Okay, so let's say you have an individual male who owns an annuity. It's going to tell you, obviously, that it won't apply the shared benefit rider because it's not a joint policy, so we'll take off this rider. Also, we'll see this oftentimes on single pay because when you're doing a 1035 exchange, it's really convenient to do it in one transaction. And of course, the other benefit is you get a guaranteed premium for single pay. It will also show you a warning that you're not going to buy this waiver rider, which I was including in all of those examples. We'll take off the waiver rider. So $49,000 single premium for this individual age 60. When he hits age 85, he's got up to $600,000 of protection. Still a lot of value on the underlying plan design. Now let's take a look at what happens if he has an existing non-qualified annuity policy. Again, we're going to flip the pie chart around and we're going to drill into the premium. Two big advantages. Actually, the biggest one is the fact that he can avoid paying out of pocket by using his existing cash value. So he might be sitting on an annuity. He bought it for deferred interest buildup. He doesn't need it for guaranteed income for life anymore, but he's still trying to cover his long-term care risk. He can use the cash value to pay for the premium without paying out of pocket. Okay, so I'm going to pretend that he has a $50,000 cash value in his non-qualified annuity, and I'm going to also assume that he bought it for $25,000, so that's the cost basis, meaning that over time it's accrued $25,000 of gains, and now it has a $50,000 cash value. The primary benefit is the fact that he can use this to fund the single premium product, and voila, he's paid up in a long-term care plan that has significant value. But the secondary benefit is that if he has gains in the contract, in this case $25,000, because the benefits are tax-qualified, tax-free benefits, the government in the Pension Protection Act allows you to use the full cash value, including the gains, to pay for the premium, and therefore he gets rid of a future tax liability. Because on an annuity contract, at some point in the future, usually people pay their ordinary income tax on the distributions, or maybe their estate does. In this case, because he's using it fully for long-term care, of course, it's not guaranteed to have a return, but it's for asset protection purposes. If he has a long-term care claim, he gets to use all of those gains to subsidize the premium as well. So when we think about the $25,000 and we think about his future tax rate, so we're going to assume his future tax rate is 35% on the distribution. You multiply those together, he has about $8,600 of tax savings. So again, we're looking at a $49,000 premium. Net of tax is only $48,000. When considering the future tax savings, again, you're going to increase the value of the plan. So a great opportunity. You can also do this from non-qualified life insurance. So if you ask your questions, those two questions, do they have a business of any kind? Do they have existing non-qualified life or annuity policies? You're going to find a lot of people that are incentivized, interested in taking care of their long-term care needs. Okay, I covered a lot here. One more thing I'll cover just briefly is the target premium approach, and then we'll open it up for questions. So if let's say he has a $30,000 cash value annuity, the great thing about using these tools, and again, set up a meeting with us if you want to use these tools right now in advance of us releasing this one. $30,000 annuity means that $19,000 is out of pocket to pay for the total premium. Just simply change the benefit period or the daily benefit or any of the factors you'd like. Let's make it a $120 a day policy, see what happens. It reduces that out-of-pocket cost. How much is that going to buy him in terms of a target amount of daily benefits? $90 a day happens to be very close to $30,000. That takes away the out-of-pocket cost. Look how easy it was to do a target premium approach. That's why I always say, make sure you understand the client's target premium in any case, and then you'll be able to design exactly the right plan for them. One more example of a target premium. I'm just going to take this kind of random example that we have set up here. This is a $1,200 a year premium for this individual. You can make it, let's say his budget is only $1,000. You can change any of the factors here very quickly, easily, figure out, okay, a 4-year benefit is still a little bit too high, maybe a 3-year benefit. Oh, there is your $1,000 a year premium. So again, use this to understand their budget first, understand their qualification first to figure out if this plan is the right plan for them, and then you can design the plan really quickly and easily to hit that budget. You'll be really, be able to give them multiple solutions potentially. You can change the daily benefit or the benefit period, but you'll know the options right in hand when you go and you see the client. Okay, talked a lot. I know there's so many opportunities here. This is just the first of many, I think, webinars that you guys will probably see. So if you do have future questions, don't hesitate to call and set up a workshop, and we'll do some more drill down into this. Tom, with that, why don't we open this up for questions?
You bet, I will. I'm going to open it up just a second for questions. First, Mark, thanks a lot in advance. Great job. I did have some typed-in questions. My question to you is, can you see those over on the right-hand side of your screen, or can I address those with you real quick?
I cannot see the question panel.
Okay. We had a few good ones. I'm going to hit those first, if you don't mind, Mark, because I was going to start typing them in, but a lot of these I just figured would be better coming right from you. The first one was about being recorded, and the other one was smoker definition. Does that include cigars or other tobacco use?
It does. It's really tobacco and anything similar. Even vaping could be considered smoking. So definitely take a look at the underwriting guide, but most of those would be considered smoking.
Okay. Then we had a question about coordination or conflict with other TQ long-term care plans. Yeah.
Okay, great question. For NGL's products, if you have a client with an existing plan, they're looking to add on the new plan, the total daily benefit amount, the original daily benefit amount of their current policy and the amount you purchase for NGL can't sum up to be more than $300, which is our maximum. So if they already own a $100 plan, you can buy up to $200 on the new plan.
Oh, good answer. Good. Okay, and we had another one about qualified for partnership. I think you covered that. It's not quite ready for partnership, but you're filing it?
Yeah, just a little bit more details. We are approved in 4 states currently, and we're looking to get approved through many of the other states this year. We're currently working on that. So probably by the end of the year, we'll have the majority of the non-RWJ states, so those non-special states. This should be available for partnership in all states eventually, except for California, Indiana, New York, and Connecticut.
Okay, thank you. And this one I think is going to come about with semantics, but cash surrender option, question mark. I thought tax-qualified LTCI rules prohibited cash value buildup in a plan.
That's actually a good point, and the interesting thing is you are allowed by regulation to add it as a cash surrender option. So it's not considered a life insurance cash value. It's considered an extra option. It's been around, actually, the market for 15 or 20 years, maybe even longer than that, but it's one of these lesser-known facts about long-term care is that you can offer that. So that's why we can do it on this plan. You have to buy it with the return of premium, though, if you're buying the cash surrender. You can't buy it without.
Right, very good. Monthly benefit available instead of daily?
Not at this time. We are considering that for a future generation product, but for this product, we wanted to keep the premiums as affordable as possible, so we're offering it as a daily benefit. I think you'll find that, at least for facility care, they'll be similar. For home health care, there might be a small difference in the total value there, but generally speaking, it's not significant, at least from our database of experience.
Perfect. What is the, this one's a little cryptic to me, what does the statement 5% YOY increase mean? I think that maybe
yes, I know what they're talking about. Sorry for using an acronym there. Let me go back to that slide just so you can see. This stands for year over year. So the one thing I wanted to point out, and I didn't mention it, is it happened that the IRS increased the age-eligible premium limit 5% last year. It was much more than usual. Typically, it's about 3%. I actually did some research into this, and it turns out it's linked to healthcare inflation costs. So if healthcare inflates more, they actually increase these limits even more. Good question.
Good, thank you. This next one, I'm not sure if it's typo. It says SP and then FPR, so I think he means specifically for carve-out. Can they do it if they are under 60 years old? So
Oh, absolutely. So, as long as they qualify for the plan, so they have to be at least 40 years old to qualify for the plan, you can do a carve-out. Again, if they're a C Corp, you can deduct their benefits in full. If they are a small business, you want to consider the fact that their age-based limits are going to be lower. Okay, so the deductibility might be lower. I looked at some situations with business owners that are in their early 40s even, okay, and lifetime pay makes a lot of sense even versus 10 pay because it can take that deductibility and they'll kind of grow into extra deductibility over time potentially on the plan. So again, it's a long-term planning solution, but you can do it for any ages that are eligible for the product. Key caveat is that they're earning income because it's a deduction. If they're not earning income, it doesn't add value to do it that way.
All right, good answer. A couple more. Is there a return of premium for businesses, and does that affect anything on how you were setting things up?
Okay, great question. This is more of an advanced question because it does depend on specific tax advice for that particular situation. Return of premium is not really considered a life insurance benefit. It's not really considered a long-term care benefit either on a 1099 form. So it's kind of a gray area that hasn't been well defined in the tax code. So if you add on return of premium for the carve-out situation, just consult a tax advisor as to how to treat that rider.
Good way to answer that. Should a self-employed business owner put the spouse on the payroll before this plan? Some of these are more advanced. I'm sorry, I'm just
yeah, so this is definitely an advanced topic. I'll cover this one, which is if you have an employee and they're a less than 2% owner, they're actually covered in full, kind of like a C Corp, even if it's for a small business. Now, I typically look at business owner situations the most, and that's the one I was covering. If they're a spouse and a non-employee, they're covered like the owner would be with the age-eligible limit. So, yes, you could add them to the payroll, and it might add some deductibility for that spouse situation. For the joint policy, you want to take a look at what that means exactly, but that gets a little bit esoteric and more complex.
All right. Boy, we're getting a lot of questions. I hope that's okay. What does the rope do for the last example of 1011 premium? I'm not sure where that one came from.
Okay, here's our 1011. What was the first part of that, though?
What does the rope or return of premium do for the last example? Okay,
oh, yeah, it's a great question. I've seen some interesting plan designs that you might not even consider. So let's say we look at a $1,000 plan for this individual, and you say, but he doesn't want use it or lose it. You can add on return of premium. What happens? It's a $2,000 plan. If he doesn't use his long-term care, he gets his premium back. Let me show you kind of another situation along those lines. Remember that $50 plan I was doing for a joint couple? Okay, this is with inflation for two individuals. This is a combo product that's $1,400 a year. You buy it without inflation. Here's a combo product for $800 a year because they're getting their money back. There's a lot of creative things you can do here if you know what their needs are. You can build the most affordable plans you've ever seen probably in long-term care. Keep in mind the benefits are going to be limited to a certain amount, but it really addresses certain needs. So, yeah, add return of premium. You can do this as a single pay plan. I mean, it's probably shocking to think somebody who's kind of a middle market person wants to just pay it up right away, 15 grand for a combo product that's fully guaranteed premium. I mean, but these are some interesting things you can explore.
Thank you. Had a question about commissions. We'll deal with that separately. We don't talk a lot about commissions because of the wide group on a webinar, so I apologize about that, Jim. And the next one is there an underwriting chart for illnesses that are not acceptable?
There is. So I'm going to show you, actually, that's a great segue into getting into the NGL website, which gives you a lot of information. So, of course, contact GoldenCare for any questions that you have. But if you go to the website, this is also a good self-service resource. You go to the agent login in the top right corner. So this is ngl-essentialltc.com. That's the official website. Agent login. You can request access, and you don't have to be appointed. It's just-in-time appointment in most states. Once you get your access, just log in. You'll set up a PIN. You're in the website. And on the website, you'll have a lot of available resources to you. The state availability map is here. So as we release new states, they'll be listed here. The recorded webinars that are public are here. So there's about a dozen of those. If you want to do any kind of catch-up, of course, listen to this webinar again, too. If you want to download any of the available marketing tools, they're right here. And that includes the underwriting guide. So that would, to answer that question, in the underwriting guide, it will give you a great step-by-step as to how to do pre-underwriting. You can contact an underwriter directly, get advice on a case. They'll tell you send it in with the case, and if it's everything you said it was, you'll get a consistent answer to that. We've been doing this for almost 30 years. Our underwriter's extremely experienced, and you'll get a good experience with that. If you want to download the BenefitsBuddy tool, you can download that right here as well. Just hit the icon. You can download that. And there's a lot of other materials that are here and will be released here. To run the official illustrations, it's not the premium calculator. That's just your plan design tool. You'll go to the sales illustration software on the web. You'll type in the same benefits that you chose in the BenefitsBuddy, and you'll come up with the same premium that was quoted in the BenefitsBuddy. But here will be your official illustration to present to a client. So it's all on the website. Definitely make use of that. There will be a lot of stuff coming out on the website in the near future.
All right. Thanks, you guys. And, of course, our GoldenCareAgent.com website has links and stuff so we can get you some of these tools as well. As a matter of fact, questions, a couple of people asked about the Benefit Buddies. He just showed you, Mark just showed you how to get it on their website. You can certainly do that along with the underwriting guide. We plan on sending you guys out that Benefit Buddy tool based on the email that you signed into the webinar with as well, so be on the lookout for that. Another question, if you don't mind, is if a person buys a policy today and the coverage becomes partnership qualified in January of 18, for example, would the policy become retroactive to initial approval date?
Great question. So assuming it gets approved for partnership, and as I mentioned, there's 4 states where it's not getting filed, but most of the states we plan to file, and we don't expect any issues. We do plan to make it retroactive in the different states. They have different rules for doing that, but if you buy a plan today with the minimum requirements that are needed for partnership, you will get an offer. That's what we expect to offer as long as it gets approved by the state.
Right. Somebody asked a question, uses a pool of money but is still limited to daily amount. Yep, that would definitely be true. Just like other long-term care policies out there, there's going to be a daily maximum that they'll reimburse.
You know, one extra fact about that, though, which I found interesting, some of you may know, if you don't use your full daily benefit amount, it does add on to your pool towards the end. So you might have a 3-year benefit period, and if you didn't use the full daily benefit, you might have longer than the 3-year benefit period until you use up the full pool. So that is a nice feature of that.
Absolutely. Access to Benefit Buddy, we talked about that. Is home care included, or can it be added? At the beginning, well, go ahead, Mark. I'll just keep turning.
Yeah, so I was quoting comprehensive plans, meaning facility, assisted living, and home health care. There is another option to buy facility only. Comprehensive plans are by far the most common because people like to age at home first, so that's why I was showing you, but this does include home health care benefits. The total daily benefit regardless of the care setting, though. It's not for each care setting.
Good answer. If the client has taken tax deductibility for premiums, what happens to tax deduction if they take rope? I think we kind of talked about that. We don't want to get too deep into that right now, Skip. And another one was you showed a map that looked like there was no plan in Florida. Is this available in Florida?
Good question. So let me show you the map again, and just to give you information about individual states. So currently all of the dark blue states are available. The light blue states also have partnership in addition to being available. And then if we look at the gray states, we're currently filing in all these states. The next release, we haven't sent out the formal announcement, but the plan is to have it available in early September, which is Indiana. It's been approved. We're just implementing it. Probably the next state after that will be Florida. We're close to getting a resolution on Florida. We're working with their regulators right now to get this approved, and so I think it's coming soon, again, towards the end of the year. California, New Jersey are ones we're actively working on as well, again, towards the end of the year or early next year. Montana will get thrown in there at some point. They have some special regulations. And as I mentioned, New York is going to be something we are going to file for in the near future, but it will take a little bit of time to get it approved. So that gives you hopefully an idea. Hawaii as well is something that's pending and hopefully will be approved soon. So all of the states, again, probably most of them by the end of this year.
Perfect. Thanks, Mark. And that's one of the things, folks, remember on our website, if you go to our product availability, I can't imagine it's not there because it is for the other products, so I'm sure we'll have a link right there as well, right in our GoldenCare site under NGL, of course, where it'll show that, and we keep that updated as well. So you guys have that. That was all the written questions. If you want to, we can try to open it up. I know we're getting to the end. I do want to let everybody know, because I know some of you will jump off because you planned on an hour webinar, so I'm going to do a little closing here before we open it up because there will be some loud background noise. First of all, again, this is Tom Randall from GoldenCare. I want to thank you guys for taking your time out today, and I especially want to thank Marc Glickman for spending his valuable time to come on here and do a great job of explaining this product. I will tell you, folks, like I do at all these webinars, the next step is up to you. There's a lot of folks. We got an aging America out there that need help. They need products. They need your education experience. So take advantage of this. Don't sit back and think, oh, someday I'll look into this. Take advantage. Take the next step, because that's something we can't do for you. So get appointed. We'll send you some information based on your email that you sign in with. Take the next step and get appointed right away, and let us start helping you help other people. Some people asked about support, and I'm not going to kid you. We know our weaknesses here at GoldenCare as well as our strengths. We've been doing this a long time. This product's relatively new to us. We're getting our arms around it, too, as far as our sales team. So we do have some great people here with our regional directors and marketing support who will be able to steer you in the right direction. Right now, if you have questions, I would urge you to, if you have a pen there, just write down Tom R, T-O-M-R, that's for me, Tom Randall, Tom R, at GoldenCareUSA.com. And you can email me stuff, and then if I don't know the answer or can't get it, I'll certainly forward it over to Mark and his team, and somebody will be able to get you a quick answer for sure. Mark gave you his information as well earlier on. And also call us at 800-842-7799 here at GoldenCare, and we can certainly help you there as well. So that being said, I didn't want to totally shut you down and have you all sign off, because I'll open it up here, and we'll have some background noise. You can push *6 to mute your own phone if we hear a lot of noise, and just listen in. And if you want to unmute, you push *6 again. That being said, I'm going to open it up, and hopefully we'll have a couple more questions. And Mark, again, thank you so much. I know it'll get chaotic here, so I may not be able to tell you, but thanks so much for your time, and I really appreciate it as well. All right, we've got you open up for talk mode. Does anybody have any other questions for Mark?
Yes, two questions. Is there any reason why you couldn't use Roth money? And second one is, I missed the point where you said if someone is on claim or going on claim, what should you use at that point?
So Roth money I'm not too familiar with. If it's post-tax dollars, which I think is Roth, I think you can use it just like you would use out-of-pocket dollars. Tom, I don't know if you have a better answer than that.
No, I think I'm in the same boat as you. And again, it would become from limited background.
Yeah. I will say that for pre-tax dollars, you generally can't use that except for HSA funds, where they have a special exemption for HSA funds, which you can use to pay your premium. But if you're using qualified money, in other words, IRA or 401k funds, you can't use it to pay for long-term care typically, or do 1035 exchanges out of qualified money.
Okay, and what was the point where you said this is what you'd want to use if they're going on claim or close to claim?
I'm trying to remember. It's escaping me, though, exactly what I said now on that.
Okay.
Mark, I think you were Mark, you were talking about like a annuity with accelerated benefit.
Oh, right.
That some people sell.
Yeah.
So, I hear what you're saying. Yeah, so what I like to do is do a health-based funnel approach. So if they're very healthy, you're going to be looking at EssentialLTC. If they're already on claim, there is some what we call substandard, meaning the underwriting, the health is not as great. We call them SPIA products, so single premium immediate annuities. There's some carriers out there. I won't mention the carrier names. I'm not trying to promote different carriers, but there are some good options out there for people that might have health issues where they can buy long-term care coverage, and given their limited life expectancy, they can get some value for their single premium.
Thanks.
Tom will be able to help you with the right solution on those.
Right. Very good. Anybody else have any other questions for Mark? All right. Well, I know we've taken a lot of Mark's time, so I really appreciate you guys again jumping on. And Mark, thank you very, very much for spending your valuable time again. And if anybody has any questions, like I said, Tom R, T-O-M-R, at GoldenCareUSA.com. I'll make sure somebody gets an answer to you. And otherwise, be on the lookout for that email that'll have the tool for the BenefitsBuddy and also some other materials for you to help you get your arms around this product. And take the next step, folks, and get appointed, and let us help you get out there and help more people. We've got a whole bevy of products, like Mark had mentioned, to help you help other people. So unless you have anything else, Mark, I will.
That's great. Thanks so much for the time, everyone. I really appreciate you guys hosting GoldenCare. Take care.
All right. Thanks again. Thanks, everybody. You guys have a great day. Take care.